In 2026, something unusual is happening across the United States. People aren't just moving for better jobs or bigger homes. They're leaving entire cities, cities they once believed were permanent. Housing costs have climbed faster than incomes. Insurance premiums are quietly exploding, and local taxes are draining household budgets year after year. As a result, a small group of major US cities is now losing residents at a pace few expected, not because people want to leave, but because staying has become financially unsustainable. In this video, we'll break down 5 US cities where Americans are leaving in the highest numbers in 2026 and the exact housing, insurance, and tax pressures driving that exodus. If you live in one of these cities or are considering a move, this information matters. The city losing more residents than almost any other in 2026 is New York City. For decades, New York was considered untouchable, expensive, crowded, but worth it. That equation is now breaking down. Housing costs in New York remain among the highest in the nation. Even with slight easing in home prices, mortgage payments still consume more than half of the median household income. But housing is only part of the pressure. Property taxes, state and city income taxes, and some of the highest insurance costs in the country continue to squeeze both homeowners and renters. For retirees and fixed-income households, these costs compound quickly. Staying in New York increasingly requires either a very high income or existing wealth. As a result, thousands of residents are relocating to lower tax states and more affordable metros each year. Not because New York has lost its appeal, but because it has lost its financial tolerance. The second city seeing a sustained resident outflow in 2026 is Los Angeles. For years, high prices were justified by opportunity, weather, and culture. That trade-off is no longer working for many households. Home prices remain elevated, even after cooling. Mortgage payments and rents continue to outpace local income growth. Insurance is now a defining pressure. Wildfire risk has pushed premiums higher and reduced coverage options across large parts of the metro. Add to that state and local taxes, congestion, and rising everyday costs, and the math stops making sense. In 2026, Los Angeles isn't losing residents because demand disappeared. It's losing them because the cost of staying has outgrown the value for a growing share of people. The third city, seeing a sustained population decline in 2026, is San Francisco. Once the symbol of innovation and high-paying opportunity, the city now faces a different reality. Housing costs remain extreme. Even after price corrections, mortgage payments still require incomes far above the local median. But affordability isn't the only issue. Remote work has permanently reduced the need to live close to downtown offices. As high-income workers gained geographic flexibility, many chose lower-cost regions with fewer taxes and lower insurance risk. At the same time, strict zoning and limited new housing supply continue to keep prices elevated. In 2026, San Francisco isn't losing residents because jobs disappeared. It's losing them because location is no longer worth the premium. The fourth city experiencing sustained population loss in 2026 is Chicago. Unlike coastal metros, Chicago's problem isn't extreme home prices. It's long-term cost pressure driven by taxes and public finances. Property taxes in the Chicago area have continued to rise. For homeowners, especially retirees, those increases compound year after year. At the same time, Illinois' state tax structure offers limited relief for fixed-income households. While housing may appear affordable on paper, the total cost of staying keeps climbing. Many residents aren't leaving because Chicago lacks opportunity. They're leaving because predictability matters and long-term costs feel increasingly uncertain. The fifth city seeing our sharp resident outflow in 2026 is Miami. For years, Florida attracted Americans with low taxes and warm weather. But in Miami, the cost equation has shifted. Home prices surged rapidly during the pandemic. Now, insurance costs are rewriting the math. Property insurance premiums have risen dramatically, especially in coastal and flood-prone areas. In some cases, insurance now rivals the mortgage itself. Add rising HOA fees, storm risk, and climate uncertainty, and affordability becomes fragile. Miami isn't losing residents because demand vanished. It's losing them because risk has become too expensive to ignore. The sixth city seeing a steady resident outflow in 2026 is San Diego. At first glance, San Diego looks like a success story. Strong demand, good weather, and a stable job market. But affordability tells a different story. Home prices remain extremely high relative to local incomes. Even small homes now require high six-figure incomes to buy comfortably. Insurance costs are rising here as well, driven by wildfire risk and coastal exposure. Add state taxes, high everyday expenses, and limited housing supply. For many middle-income households and retirees, the math simply doesn't work anymore. San Diego isn't losing residents because it's undesirable. It's losing them because it's no longer financially realistic for long-term living. The seventh city experiencing continued resident outflow in 2026 is San Jose. At the heart of Silicon Valley, San Jose was once the ultimate housing market. High prices were tolerated because incomes were even higher. That balance has quietly shifted. Home prices in San Jose remain among the highest in the United States, even after market cooling. The typical home still requires an income far beyond what most households earn. But the real change isn't just housing prices, it's how people work. Remote and hybrid work have reduced the need to live near tech campuses. High earners now have the option to live elsewhere without giving up their salaries. At the same time, California's tax structure, rising insurance costs, and everyday expenses continue to stack up. For homeowners, property taxes and maintenance costs remain high. For renters, rent relief has been limited compared to income growth. San Jose is no longer losing residents because opportunity disappeared. It's losing them because the premium once justified by proximity is no longer necessary. In 2026, San Jose represents a broader shift in the U.S. housing market. When location stops being essential, cost becomes impossible to ignore. The eighth city seeing continued resident outflow in 2026 is Seattle. For years, Seattle combined high-paying jobs with a strong quality of life. But the cost structure has shifted faster than incomes. Home prices remain elevated even after cooling. For many households, the gap between income and ownership has widened. Insurance and property-related costs are quietly adding pressure. In parts of the region, premiums and maintenance costs have risen alongside climate-related risks. At the same time, remote and hybrid work have reduced the need to live near downtown offices. That flexibility has changed migration decisions. For middle-income families and retirees, the appeal of Seattle increasingly depends on whether the lifestyle still justifies the long-term cost. In 2026, Seattle isn't losing residents because opportunity disappeared. It's losing them because the margin for staying has narrowed. The ninth city experiencing continued resident outflow in 2026 is New Orleans. For decades, New Orleans offered relatively affordable housing compared to other major cities, but affordability here has always come with risk. That risk is now showing up clearly in housing decisions. While home prices are expected to soften, insurance costs are moving in the opposite direction. Flood insurance, property insurance, and maintenance costs have risen sharply. For homeowners, these expenses directly reduce purchasing power. For buyers, They shrink loan eligibility, even when prices fall. Zillow forecasts one of the largest home price declines in the country here in 2026. But lower prices alone are not enough to offset long-term risk. As storms intensify and insurance becomes harder to secure, many households are choosing stability over affordability. New Orleans isn't losing residents because homes are cheap. It's losing them because uncertainty has become too expensive to manage. These factors don't show up directly in housing statistics, but they strongly influence relocation decisions. Remote work has added another layer. Many residents who once needed to live near the city no longer do. In 2026, Portland isn't losing residents because it lost its identity. It's losing them because the cost, uncertainty, and trade-offs no longer feel justified. When you step back and look at these cities together, a clear pattern emerges. Americans aren't leaving because cities suddenly became undesirable. They're leaving because the cost of staying has outpaced the value of living there. Housing prices, insurance premiums, taxes, and long-term risk are now shaping migration more than jobs or amenities. In 2026, the U.S. housing market isn't defined by a single crisis. It's defined by uneven pressure, where some cities remain livable and others quietly push people out. For homeowners, renters, and retirees alike, the lesson is the same. Affordability is no longer just about price. It's about predictability, stability, and total cost over time. Because in today's housing market, the biggest mistake isn't waiting too long. It's committing to the wrong city.